Hi, this is Me10 Television discussing United States stocks. This video is being broadcast live simultaneously through a partnership with Mijuyun Television. Today's Blue Chip Stock Analysis segment is about a company called Toast. The name is quite interesting, isn't it? As you can see here, their logo even has a toast shape. There's a toast shape. So you might think it's a company related to food, but actually this company doesn't make food. Instead, it's a company that provides specialized payment services for restaurants. Today, let's take a look at this company. This segment is not a stock recommendation segment. So I hope this segment helps you broaden your knowledge of companies and learn how to interpret them based on data. If you look at the stock chart from the past year, it has risen significantly. So the lowest point was around the 52-week low, starting at $22, and now it's around $47, so it has more than doubled. It has risen sharply and significantly. And if you look at it the other way, when the stock price falls, it drops sharply as well. For example, it fell from about $44 to $28, so the stock price fluctuation is really big. Due to their smaller market capitalization, these companies experience significant fluctuations based on index changes. If the index drops sharply, these stocks will likely fall more than the index. However, if the index stabilizes, they could recover faster than the index, showing strong resilience. These companies have high volatility. Keep this in mind as you review it. Recently, as you can see from the green box I drew, the stock price has slightly broken out of the range it was in. With this upward breakout, we can say that the stock is showing signs of an upward trend. To explain a bit about the company's business, this company specializes in restaurant operations. So they provide SaaS platforms that offer comprehensive services for restaurant management. They don't just provide simple payment gateway services. To run a restaurant, you need an order system, point-of-sale terminals, and when orders are placed, the kitchen needs to receive a list of what has been ordered. You also need to process payments, manage customers, and issue coupons depending on whether a customer is a regular or not. And then there are employees and staff working at the restaurants, right? A system that manages payroll for the employees and handles all the accounting processes as well. It's vertically integrated. It's a company that provides a SaaS platform specialized for the restaurant industry. That's the right way to look at it. I think it's better to distinguish it from competitors that only provide payment platforms. We currently serve around 140,000 restaurant companies globally. The company's annual recurring revenue has reportedly risen to about $1.6 billion. So compared to last year, it increased by about 31% as of the first quarter of this year. This level of revenue accounts for about 40% of last year's total revenue, and since this is annual recurring revenue, it means it's essentially locked in as a subscription service. So the higher this proportion is, the more stable cash revenue the company basically secures. You could say that this company, which is steadily securing a significant amount of stable fixed revenue, is building a good business model. In a way, you could consider it a small to mid-cap stock. The market share is about 13% of all restaurants in the United States, and the payment amount accounts for about 15%. The picture you see on the left is a point-of-sale terminal, so I brought an image to show you. And recently, in the first quarter of 2025, which is the first quarter of this year, they announced two major contracts. They signed a contract with a restaurant called Paul Bisou, and then announced that they had signed a supply contract with a store called Tap Golpew. So by expanding these kinds of stores, it seems that they have enough momentum to drive sales growth as well. Pulpisu is a restaurant. A company called Topgolf is related to golf, and if you compare it to Korea, it's kind of similar to online screen golf. So you go there to play golf and analyze your swings, and the restaurant sales there are actually quite significant. At Topgolf locations, over 40% of their revenue comes from food and beverage sales at the restaurant. So as Toast provides its services, this company is expanding into other areas. So right now, this company is firmly establishing itself in the restaurant sector and growing its business. And I think this might be the first step toward expanding not only in restaurants, but also into other areas. And now, through a partnership with Uber, they're expanding these partnership points so that they can deliver food to restaurants through even more affiliates. I think it's worth keeping an eye on which areas this company could grow into in the future. If you look at whether it's a blue chip company, it's in the top 14%, so it's definitely a solid company. It scored 67 points, but what we need to pay attention to is that its future growth potential is 80 points. Its financial stability and cash flow are quite high. And overall, you can see that it's a growth stock, shown in a triangular shape like this. Profitability rises as margin rate increases, so it's currently in an early growth stage where margins are expanding. The part we need to pay close attention to is this part. The SMART score has increased significantly over the past year, rising from 36 points to 67 points, demonstrating tremendous growth. Companies like this experience significant stock price increases over a year, and their stock has risen substantially in the past year. So as these companies' overall scores rose from 36 to 67, the scores kept increasing, and as they went up, the stock price also rose very quickly like this. These companies are worth watching closely. Next, later on, I'll show you on the actual screen, but the scores for each category have also increased significantly. The company's Q1 sales based on the last 4 quarters totaled $5.2 billion, a 26% increase from the same period last year, indicating a high sales growth rate. Next, the earnings per share has turned positive, and as of the second quarter of 2024, it continues to show a profit. In fact, after turning profitable, the earnings have been improving at a very rapid pace. The operating profit margin chart on the right shows the margin turning from around 10% to positive, now at about 2 to 3%. However, in the next 2 to 3 years, securities firms are expecting the net profit margin to reach about 6% to 7%. So, since the current net profit margin is 3%, even if sales stay the same, profits will enter a range where they double, because the profit margin itself will double. Since there will also be sales growth, we can estimate that the net profit growth rate in the next 3 years will be more than double. So we can also check this through the consensus data available in the future. The company's balance sheet shows total assets of $2.5 billion with $1.5 billion in cash equivalents and short-term investments. I mentioned that when this happens, interest income and other profits related to financial investments are generated. Besides operating profit, this company will generate non-operating income. If they don't spend this money, this income will likely continue in the future. That's how you can view it. This company has a significant amount of other assets, totaling $2.5 billion, which is quite high compared to their $500 million in other assets. Most companies don't have such a large proportion of other assets. But as this company does business, other assets and other liabilities tend to arise. For example, it's like this. Just because you make a payment doesn't mean you get the money right away. So if you receive the money later, after making a payment, that amount becomes money you will receive in the future. So it's recorded as an asset. And since it eventually turns into cash, even if there are a lot of other assets, it's not really a problem. That's how you should see it. On the other hand, are there amounts that need to be paid to restaurants? If they process the payment and receive all the money first, but then need to pay the restaurant or supplier later, they receive the money first and pay it out later. So it's recorded as a liability. It's listed as other liabilities. So even though other assets and liabilities are high compared to other companies, it's just a result of the business model. If you understand it this way, there shouldn't be any problem. The non-operating income shows that interest income from cash equivalents and short-term investments generated around $12 million as of Q1 2025. What this means is that as long as short-term investments or cash equivalents don't disappear, this income will continue to be generated until the end of this year, and this amount will be about $50 million. If we look at it annually, we can predict this. The operating profit was around $100 million. And it's expected to generate $50 million annually. That's the perspective to take. Next, there was something called the fair value evaluation of warrants. What this means is that Toast issued warrants, and a warrant is basically an option to buy Toast stock. If you have this option and Toast's stock price goes up, you can buy it cheaply. So from Toast's perspective, it results in a loss because it's a liability. On the other hand, if Toast's stock price goes down, the value of the liability decreases compared to the original valuation, so it results in a gain for the company. That's how this structure works. So for this company, I understand that the earliest maturity is from the summer to the second half of 2027, and the final maturity goes until 2027. Gains or losses from the fair value evaluation of warrants are likely to continue in the future. If you look here, Toast's stock price dropped significantly in the first quarter, and that's what resulted in this valuation gain. Since it's a warrant, it was a liability for the company, but as the price fell, the valuation decreased, which led to a gain. On the other hand, in the second quarter, the stock price went back up to its highest point. What do you think will happen then? This part will result in a valuation loss again. So in the second quarter, it will be recorded as a valuation loss. But overall, since about $3 million was reflected in the drop during the first quarter, I'm not sure how much of a valuation loss there will be in the second quarter. Based on the slope of the chart and the rate of change we just saw, wouldn't there be about a $5 million loss? So, with about $12 million in interest income and a $5 million loss overall, I estimate that there will be about $7 million in non-operating profit. This is just an estimate. That's just based on how it looks to me, but in reality, we'd have to crunch the numbers to know for sure. Anyway, until the warrants expire, it's a company where these two things can always happen. I think it's best to analyze it with that in mind. Next, if you look at the cash flow statement, you'll see that operating activities are plus $400 to $500 million, which is quite a lot. Compared to the net profit of $150 million, the cash flow from operating activities is increasing rapidly, indicating a company with strong cash flow. In financing activities, there's a positive inflow of $18 million, but since this company has started buying back its own shares, it should actually be a negative outflow. The reason it's positive is because options, warrants, and other stock-based compensations that were issued are being converted into shares, which brings in capital. The amount coming in from this is larger than the amount spent on share buybacks, so it shows up as a positive inflow. It's not because the company took out a loan or raised capital through a rights offering. Well, actually, the rights offering part is correct, because it was converted into equity. So it's not that the company needed money and brought it in through financial activities. It's more because of stock options related to shares the company issued at a low price and stock compensation programs. That's how you should see it. Stock price and earnings per share should move in the same direction. However, here the stock price is dropping in yellow while earnings per share is rising, making it a good buying opportunity. And actually, if you look here recently, this point was another time when the stock price dropped. Back then, the stock price was in the low $30 range, around $33 or $34. Now the stock price has gone back up to $47. When earnings per share rises but stock price drops, it's a great opportunity, especially if the valuation is attractive. So if you look at the stock price and earnings per share chart, this is the kind of moment I'm talking about. Earnings per share is projected to rise steadily, but the stock price occasionally dips, as shown by the blue line. Pay attention to these moments and check the valuation simultaneously for optimal insight. If we look at the projected earnings, the sales growth rate for the next 3 years is about 20%, so we can consider this a high growth stock. The earnings per share is 1,382% this year due to a base effect as the company turns profitable. In the next 2 years, earnings per share is expected to grow by around 50% annually, leading to significant profitability improvements. The chart showed companies with rapidly improving profitability and sustained growth, justifying their valuation. As long as supply and demand are favorable, they are worth including in your portfolio at any time. The downside is that the stock price volatility is quite high, similar to mid-cap stocks, which is something to keep in mind. The valuation shows there were good entry points and times when the stock was fairly priced. However, there were also times when it was significantly overvalued. Although the stock price seems poised to rise, a correction could lead to a significant drop. However, if it breaks through and goes up, the price could soar even higher, despite being very overvalued based on current valuation. Because the momentum is good, but the price is a bit high, so it would be better to buy it a little cheaper. When Q2 earnings are reported, the stock price is expected to rise significantly in this area. So if it goes up to this point, ideally $1.40 or even better, the low 30s would be the best. If you wait until it's between $1.30 and $1.40 and then take an interest, I think that would be a good price range. Factors like earnings, valuation, and supply and demand must align to increase your chances of successful investing. Paying attention to fundamentals is wise, but some investors focus solely on momentum. You can achieve successful investments with just that, but in our system we look at whether it's a good company, if the valuation is appropriate, if it's not too expensive, and also the supply and demand. When all three of these align, your chances of success increase. The reason we look at data is to increase our chances of success, even just a little, and to reduce losses or the possibility of losses. If you look at the exponential moving average chart, you can see at this point that the upward trend is strengthening, and we were able to confirm this together earlier on the stock price chart. Let's move to our website, take a quick look at the current situation, and then wrap up. The ticker is TOAST. If you look now, there hasn't been a single trading signal for this one in our system yet, but even if there isn't a trading signal, individuals can still buy it as they wish. The trading system only gives a signal when all three conditions are met. Even though the supply and demand hasn't turned around yet, I think it's really attractive in terms of valuation. If I decide to buy, I can start buying in portions from then on. The reason we inform you based on data is so that you can make those judgments on your own. We recommend you refer to our site, but that's why we explain it this way. So if you look at the valuation here, the current valuation itself is quite high right now. These points would have been good, like in April, and at this point in August last year, those times were pretty good. Those periods definitely come whenever the stock price goes through a correction. It never rises forever or stays overvalued forever. So if you look here, recently the stock price has moved a bit out of this box range, and if it gets some support here, it could gain upward momentum. But we need to know that the valuation is expensive. That's something we should keep in mind. Here, as I mentioned earlier, if you look at this chart showing the increase compared to the same period last year, you can see it rose very quickly from 36 points. If you look at each category, the growth score jumped significantly from 45 points to 80 points. Monopoly power doubled to 40 points, financial stability rose from 60 to 100 points, and profitability quickly improved from 0 to a 40-point margin rate. Cash generation ability also increased from 55 to 70 points. The scores were high across all categories. So through these factors, the overall score increased, and these were very important fundamentals that significantly contributed to the long-term rise in the stock price. So I hope looking at these aspects as a whole will be helpful for you when you invest. Please subscribe, like, and leave a supportive comment if you found this helpful. Thanks.